Good morning, and thanks for joining us here on Treasure Coast Solutions every Wednesday from 9 to 10 o'clock. We talk about some of the economic issues that you may be facing, some of the tax, some of the business issues, or just general things that you may be facing as an individual or as a business, some of the economic issues that are happening nationwide, worldwide, and that could translate into your pocketbook, plus or minus, depending upon what you're looking at. My name is Mark Breckbill. I'm a CPA and a financial planner, and I do a lot of business planning and those kind of things. I was a banker for about 13 years in the as a chief financial officer and then a chief operating officer for a while, and had so I've been involved in the banking industry for a little bit of time. In fact, when I started my public accounting career in the old days, my first clients were bank clients. I was involved in the banking industry, so it's been kind of an interesting thing, and it's actually given me an opportunity to see some of the financial issues and the economic issues that occur that a lot of people just aren't aware of what is happening behind the scenes, and it's that's been fun. I mean, I will when I was a banker, I liked being a banker because you got to deal with a lot of issues, a lot of cutting edge type things, because your clients all had, they all had these issues going on, different ones, but all things that you were the first one to address them, because financing is the big issue. People don't have the problem if they don't have the money to be able to solve the problem. Sometimes they need the money to keep it from beginning to be a bigger problem. And so it was kind of a interesting a time, because you'd get to see a lot of that, and especially on the loan side, where you have your clients coming in and borrowing money, and you're looking at their financial information. So that's kind of a little bit of my background and what I've done in the day. I've and as at this point have a family-owned business. It's a CPA firm. I do that, and it's kind of fun. But but what I wanted to deal with this morning is some of the issues we've been talking about over the time here, and some of the things that I see happening, and that we probably and that I would want you to kind of know what's going on so that you can be aware of it, maybe make some plans. Because with anything, having options is a good thing, and that's what we're talking about here. So sometimes when I talk about things, it sounds a little pessimistic, but you have to look at both. You have to look and find the downsides to be able to find the upsides. Um, it's kind of like I'm a big believer. You can't really appreciate what you've got till it's gone. Oh, wait a minute, that's another song. But I think it's true to a large degree. Sometimes you don't appreciate what you have until you've seen what you didn't have, or you've experienced the other side of that. And that's why I think, from a planning perspective, particularly from a personal planning and a business planning, it's important to understand what the pitfalls are, and what could happen. So um, and not all and that always does, that doesn't always come to fruition. The case scenario doesn't always happen, unless you're me. Then I think I almost always have the worst case scenario, but it doesn't always happen. But it's good to know what could happen, because you can then learn from, you can learn from somebody else's mistake or somebody else's problem, and that's a whole lot easier than learning from your own problems. You learn a lot from your own problems, but I don't normally recommend it as a starting point. If you can get a mentor or somebody who can maybe say to you, "Hey, this is what might happen, and here's what you might want to look at." It's funny. I think that it, from a planning standpoint, and from looking at some of these things, you know, the older I get, the better planner I am, because I've seen more things. I have had more opportunity to experience the downside, and we learn a lot from that. I know years ago, um, my clients used to use a law firm, and probably still do. Um, this was a number of years ago, for estate purposes, and the And the attorney was a guy named Michael Minton up in Fort Pierce. And the reason Michael Minton was a good estate attorney is that his family had been through it. They owned a big citrus farm, and his dad, they had a substantial amount of wealth, but they had gone through the whole thing, the transfers, that they'd actually set up the trust. They knew what did work and didn't work. They'd gone through the audits with the IRS and all of those kind of things. And so when you do all of that, you know the difference of what looks good on paper and what actually happens. And a lot of things look good on paper, and especially in very technical areas, it's very easy to look at this and stuff and say, well, see, I got in this, and this is what's going to happen, and this is what's going to happen. And the fact of the matter is that uh, the practical side of it is that, yeah, that may be what will happen, but you'll never have that happen because you'll never get there. And it's kind of funny. I was talking to somebody the other day about some business planning and some sales things and all of that kind of thing. And we were talking about structuring contracts for the sale of businesses. And I get involved in that quite a bit. I'm not writing, all the documents type thing. That's typically the attorneys do all of that. But I get involved in writing a lot of documents that the attorneys can use or that we end up using, because I have an understanding of how to transfer a business transaction that's been agreed to paper. And I come from a different perspective. As a CPA, I'm not bound by the same requirements that attorneys are. And what I'm getting at that is, and I have a lot of respect for the attorneys. I'm not just saying that they don't know, but their perspective is different. So if I'm an attorney representing a client who is going to start a business, and that business is, and he's got another partner. So let's say that my let's say my the client has money, and he's got another guy who's got an idea. How often does this happen, right? And they get together and want to form a partnership or an entity to pursue that. And so now you've really got three clients here. From a legal standpoint, you got three clients. You've got the person that's got the money. You've got the person that's got the sweat equity that's bringing in, and then you've got the entity itself. And all of those are going to need representation, or at some point will need representation. And the way that the ethics law works for attorneys in general is that they can't represent all three of those. They have a hard time representing even two of them, the entity and whoever their client is. So it's very difficult. But assuming that they somewhat can work that out, the problem is this: that their job is to put together an agreement. Frankly, their job is to put to an agreement that produces the best result for their client. Now, if you've got an attorney on the other side, their job is to put together an agreement that works the best for their client. Those aren't the same most of the time. There are things in there where, depending upon which way you go, somebody kind of wins and somebody kind of loses. And then there are other situations where you can have a win-win, but it might require you to do something that you don't normally want to do because it might create some risk that potentially could happen. And so there's a lot of things that make it very difficult for an attorney to negotiate among parties because he's got to represent one of them. Whereas as a CPA, I'm independent. I have independence. So when I'm involved in something like that, I can say to both parties, look, here's what, let's do this. Here's what we're trying to do. Here's what you're trying to accomplish. And I can point out to them, well, yeah, but if you do this, you're giving up this. So just be aware that this keeps you from, from non-competes or whatever. So and that's the kind of thing that if I'm representing the client, I'm not going to tell the other party, well, here's what it does to you. I'm not necessarily going to tell them that. I'm going to tell them you need to get representation so that their attorney will tell them what the deal is. So so when I look at these things, like I say, it's kind of a interesting situation, and so I've been involved in a lot of these transactions, where I am doing nothing more than being a scrivener. But I am negotiating the business transaction. In other words, I'm sitting down with my clients and figuring out what they want to do and what are their goals and what's important to them, what's not important to them, and what are people willing to give and what are willing people want to take, and all of those kind of things, and how are they going to be protected, and all of that, and what the downsides are, and then we come up with an agreement, and then at that point, everybody's kind of happy because they understand everything, the pluses, the minuses. If you do them right, you've got provisions in there to how to get out if this thing goes sour. Basically, you're writing a prenuptial agreement for a business is what you're doing, and that's really what we do and what I do, and it works out pretty well because I can negotiate or mediate the situation, and that's probably the better term. Is I can kind of mediate the deal and find out what people want, how they want it. But anyway, I was dealing with that the other day, and the problem with the conventional method, where you've got attorneys represent both parties, is that um, they're always pushing for the last little deal, the last little thing for their client, to protect their client, to watch out for their client, and I'm not saying that they're not legitimate, but what happens a lot of times is the deal never gets done, or it falls apart right away after it's been done, because from a business standpoint it didn't make sense to start with, or from a tax standpoint it didn't make sense to start with. So it just collapses because it just doesn't work. So if your goal is to when it collapses you come out good, then yeah, I guess that's what you want. But the goal is usually for it not to collapse. In other words, for the business to be successful, and for it to get on off to the start, recognizing that any new business is going to have problems. So it's kind of funny because sometimes you can you can plan for a situation that really isn't ever going to happen unless you don't ever make money or you're never successful. So I kind of will talk to clients, like, for example, I'll have clients say to me, well, why don't I be a C corp? Because my tax rate's 21% now, going to 28%, but it's still, you look at it and say, well, it's still less. And and you say, well, the only way you'd want to be if you're a C corp, you have to pay double taxation. And they say, well, what do you mean? I'll pull it out of salaries or whatever I'll do. Well, yeah, but you're still going to someday have to pay it. So what you're telling me is that you're never going to be successful. So you don't care about double taxation because you're barely going to make it. For because that's what a C corp's about. If you can always pay tax once, if you don't ever have, if you're never going to create anything of value, or if what you're creating has no ongoing value. If it's just a vehicle and you're not creating any ongoing value, then yeah, it doesn't make any difference, right? You can pull it out. You're probably still going to pay a higher tax bracket than you would if even on the single tax, you're going to pay a higher tax bracket than you would if you went another route, because you're going to have to pay Social Security tax on your income to pull it out. If you take cash out, otherwise, you got to pay dividends, and you got to pay tax on the dividends. And those dividends, you're going to be paying at least 25%, and now maybe 40%. So that's where we're at with that, and it's kind of so when we're looking at some of these things, what we want to do in any situation, personal is, you want to be aware of the downsides. You want to be aware of that, but you don't necessarily want to be afraid of it. You just need to be aware of it so that you can plan for it, plan around it, plan for it, take it into consideration, determine what kind of risk it really is, and go from there. And sometimes all you're talking about is avoiding that situation until it's fixed itself. It's not always about having to uh, deal with it. It's sometimes about figuring out ways to procrastinate so you don't have to deal with it. I've got a friend that always says to me, oh, procrastination is never good, and normally it is not. and definitely procrastination is not good on the planning side. Don't put off planning. You don't want to do that. But there are times when procrastination is necessary. For example, um, I didn't have a single one of my clients that I encouraged. I did have a couple that did it as opposed to my advice, but I didn't have a single one of my clients that had PPP loans go for forgiveness um, right away. Why? Because there were fallacies in the law that we knew there was a really good chance, 99%, that we're going to be corrected. Okay. But you had to be patient. You had to wait, because if you didn't and the law hadn't been changed, you were going to be potentially stuck with the previous law. And that's exactly what happened. Congress finally fixed the flaws, but they did it as of December 28th or whatever it was at the end of the year when they did that additional $600 stimulus. They fixed it as part of that. And the additional round of PPP, they fixed it as a result of that. But if you had done something previously and hadn't waited, there's a question now as to whether or not you'll be able to take advantage of the benefits that they provided. And that could be a problem. So, so it's, like I said, there was a situation that the law was there. It wasn't clear, but it had been interpreted by the IRS. But it was a situation where nobody was. So if and as CPAs, tax professionals, attorneys, EAs, others, we had to abide by what the IRS said potentially, or stick our necks out. And so we were in a position that if you did that, we would have to file, and potentially we have to treat it the way the IRS said up to the point that the government changed the law, because they didn't necessarily make it retroactive. So what am I talking about? Well, here's what I'm talking about. Uh, the the PPP loan was money that was supposed to go and be spent on payroll. For most of my clients, that's all they asked for was the money for payroll. Some pulled out a little bit for rent if they had that situation, or utilities, or a mortgage payment. But otherwise, virtually 100% of the money um, went to payroll. In fact, most of my clients, they actually paid more in payroll than they normally did. They gave their employees a bonus or some sort of hazard pay or whatever you want to call it. So they did what they were required to do on that side. But what happened is the IRS and so they were going to get their loan forgiven, their PPP loan forgiven. And according to the law, that was not going to be taxable. The IRS came out and said, yes, that's not taxable. But under this other provision of the code, we believe that you that if you use that money on expenses, if you use that tax-free money on expenses, or vice versa, if certain normally tax deductible expenses, salary, were utilized to generate that tax exempt income, then you can't deduct those expenses. So what the IRS basically said in a roundabout way, which was kind of crazy, is that, yeah, the income isn't taxable, but the expenses aren't deductible. So which in effect made the income taxable. Really, I mean, because you had to spend all of the income on wages, so now you can't deduct the wages. So basically, you were paying the taxes. In fact, to make matters worse, you not only were paying the income taxes, you also had to pay Social Security taxes, the employer portion of Social Security taxes, because they didn't give you that as a benefit. That wasn't part of the PPP. So it actually cost you taxes, and it cost you, the base problem is it cost you the taxes on that thing, including the Social Security taxes, which were 7.65%. So you paid maybe 20% in income tax and 7.65. So it cost you 30%, let's say, in taxes on that transaction, when it was supposed to be a tax-free. It was supposed to be a grant. There was also an EIDL loan, the economic injury disaster loan, and that loan was again a loan. It was not forgiven, but it had a grant with it. It was a $10,000 grant. That grant was supposed to be tax-free. That was supposed to be money, again, that was given to you really just to cover some of your employees' costs. and you couldn't double dip on that. You weren't supposed to, but you could use it to cover your business costs. Somehow, the IRS again interpreted that, or the SBA, one of the two, interpreted that the SBA basically interpreted that to say that that wasn't a grant. It was actually an additional PPP loan that could not be forgiven. So what was happening is that if you got that money, that $10,000, you were going to have to, in effect, treat that as a loan. You couldn't get it forgiven. And if you had left it as a EIDL loan, you'd have been able to pay it off over 30 years with a 3.75% fixed interest rate. But instead, it was being shifted to something that you had to pay off over a year, with a 1% interest rate, which the interest rate isn't bad, but coming up with that cash flow right away was a problem. Now they extended that a little bit, but still, in terms of the time to pay it back, but still, it was a lot faster than 30 years. And so you were having to pay that back pretty quickly, and it wasn't free money. It was supposed to be free money. So some people applied for that, thinking that they were going to get that money for free. There was a grant. They didn't even want the EIDL loan itself, and yet they ended up having to, on the application for forgiveness, they were ended up having to pick that back up. And I know clients that processed that through, and they've picked that up. And that is not taxable according to the bill. It should not have been part of the loan. It should have been a grant. You didn't have to include it. So, if you filed your forgiveness application and you got that taken back as a loan, you need to go back in to your bank and ask if you can file another forgiveness application under the new provisions and ask for that to be forgiven. Now, here's the problem. Some of the banks may say, well, that didn't apply because you got your loan forgiven prior to this new law, and therefore you were under the old law. So therefore you do have to treat it as a loan. But according to the law itself, you weren't supposed to have to. You weren't supposed to have to include that in your income. In your loan. So it should have been tax free. So there was a lot of these things that happened right at the end of the year. And so if you kind of knew what the problems were, and that was the key up front, to identify what's the bad stuff, what's going to happen, what has potentially happened. You had to know the IRS, what they were doing and what their position was. You had to know, what was going on behind the scenes to try to mitigate that, and what was the potential that was going to happen. Politically, what was the possibility that was going to happen soon or versus later, and that it was going to, what was going to happen. Was it going to be held up, which it was, all of those kind of things. And then what's the alternatives? What are the alternatives if we don't? One of the things that actually took the most amount of planning. There were two things that took the most amount of planning, and that was, one, to know what potentially was going to be included and in the PPP forgiveness, and what was questionable. Because when you were getting the loan, the key to getting your loan forgiven was how much you asked for. If you asked for the wrong amount of money, too much, you were eligible. They were going to give it to you, but there was no way it was going to be forgiven. So part of the success of forgiveness on the PPP loan was to know upfront what to ask for. And because if you wanted to get it forgiven, there was a specific formula that you needed to use to make sure that you were going to get it forgiven. Now, if you didn't care if some of it ended up as a loan, that was then that's fine. Now, under the original law, that EIDL loan was also written such that it could be forgiven. And there was the potential that it could be forgiven as long as you didn't get your PPP loan, your EIDL loan before your PPP loan. So the key there was to file for your EIDL loan, but to wait till after the date that the PPP loans were available, and to make sure that you didn't have that money available and weren't using it for that purpose. And that was all the timing on when you applied. So if you applied too early or too late, you could have got yourself into trouble. So the fortunate thing is that the SBA took forever to fund on those EIDL loans because they were so backed up. So the chances of you receiving an EIDL loan prior to your PPP loan actually being funded on it was minimal. Um, but still, it was kind of important to apply prior, but get funded after, so that you could show that you didn't spend that money on the same thing as the PPP money. And ultimately, if you did it that way, you could have gotten the whole thing forgiven. Now they didn't. They ultimately didn't clarify or fix that portion of the law, but it did fix the grant, and it made the grant not taxable. And so that has been clarified, so that $10,000 shouldn't have been a loan. It should have been a grant and been forgiven. And it's, tax-free income in effect is what it amounts to. So, so, so that's kind of what happened. That's where we're at. And that's kind of some of the things where, like I say, what the potential disaster was. The key was to kind of position yourself to avoid that if you could, procrastinate to the point that it got fixed. And if it didn't get fixed, decide how you were going to choose to address it. Even the timing of when you were going to apply for forgiveness or go for this thing was important. So that's, from a business standpoint, that's one example of why sometimes it's good. You got to do your planning. You got to know what your hot spots are, and then you decide how fast you're gonna move, or whether you're gonna drag your feet, or all of that. And it's frustrating sometimes. I know I have clients saying, "Well, why weren't we applying for this? We need to apply for this right away." And then I've got some clients that are just very, very, they're very, very, what's anal is the only word I can think of, relative to, I wanted to get, I did this. I want to get this forgiven. I want to do this. I want to do this right now. There's no reason. I want to do this. I want to do this. And you're telling them what, it could cost you a lot of money. It could cost you a lot of money. No. I mean, I just want to get it over with. Well, yeah, but if you'd have just waited, and I'll give you a good example right now. The forgiveness application. One of the things that significantly changed on the forgiveness application was which application you use. There's 3 applications for forgiveness on a PPP loan. There's the 3508, that's the basic forgiveness application. There is the 3508EZ, and there's the 3508S short form. Now, you would normally think that the EZ would be easier than the short form. That's wrong. The short form is the easiest. And so what you want to do is be able to use the short form, because the short form requires very little information that you need to provide them. You just maintain it, but all you do is certify. And if you certify it and you're eligible to file that short form, and you make those certifications on the short form, at that point, the bank is off the hook. So that's all they care about. So they're okay with forgiveness at that point, because it's not coming back to them. They're off the hook. And you, to some degree, are off the hook, because you made certifications based on, your understanding and your knowledge of the law and the way it was. And so basically, as long as you spent the money on payroll or allowed expenses like rent or whatever, that you get your loan forgiven. And as long as you spend over 60% on salaries and all that kind of stuff. So for all of my clients, it was a slam dunk, because, and they wouldn't have to, the key there is the timing of it and getting it done. Yes, they could have filed another form, but now you have to provide a whole lot of information. And as soon as you do that, the bank also takes responsibility for some of this stuff. So if they make a mistake in interpreting the information you provided, and you've made a mistake because you thought it was correct, then they're then subject to clawback. They're subject to the SBA coming back in and saying to them, "You've got a loan now. You go ahead and try to collect it, but you've got a loan you've got to deal with." And so, whereas with the short form, if the owner makes that certification, that's all the documentation that the bank needs to be able to grant forgiveness. and then send it to the SBA and the SBA to grant forgiveness. So that is a much safer process for the banks, which means that there's much less chance that those forgiveness applications are ever going to get turned down, because there's no risk for the bank at that point. There is some risk for the business owner, but no more than they already had. And if they did spend it on the way they were supposed to spend it, it just means that it's going to get approved a lot faster, a lot easier. And they won't get tripped up by some small detail. Like, for example, did they apply for forgiveness too soon? So that the old law applies instead of the new law. See, all that stuff's taken out of it when the bank doesn't have to make that decision. With the EZ, it's the same kind of thing, but the bank has to actually get certain documentation. They have to get documentation that shows what was actually spent on payroll. They need to get copies of checks. They need copies of leases. There's all of those kind of things that they need to get. And if they get it, that means they have to review it. They have to make a determination. What was the lease in place prior, at least 2 months prior to the time of the start of the covered period. There's all of these things that they had to look at, and that you could make a mistake on, or that there's a technicality that could cause them a problem. And if there's any technicality that causes an issue, then at that point, they're going to take a conservative position, say, no, not forgiven, because they don't want any contingencies. And the SBA isn't going to step in and say, no, that you're okay. The SBA does not approve these in terms of the banks approve them. The SBA just signs off on them saying, we're reimbursing you the money. They're not signing off that it's right. They're saying, we're going to give you the money based on the application from the client and your process of approval. You've done this. We're going to, assuming you've done it correctly, we're going to authorize the payoff of that loan. And that's all they're doing, is authorizing the payoff of the loan. They're not approving it. It's an authorization. They give you a number, it gets paid. So that's why it was really important to be able to use the short form application versus even the EZ. And you definitely didn't want to use the 3508. So, because those are almost all going to get audited at this point. So the EZ, they did make it, they set it up so that it eliminates a lot of the full-time equivalent calculations that were in the application. Things like, you had to determine how many people you had to maintain the same number of people. That sounds easy, but it's not. I mean, if you've got 10 people up here and you have 10 people down here at the end, you could say, well, I got 10 and 10, and so I maintained the same level of people. But during that process, in the whole application process, there was a question about, well, what if these 10 people at the beginning aren't the same as the 10 people at the end? And what if there was a period of time where I only had 5 people, or I only had 3 people, and then I went back up to 10 people? And what happens if the 10 people that I had at the beginning were working 40 hours a week, and the 10 people I had at the end are working 20 hours a week? So then I really only got 5 people. So all of that was an issue, and it's still an issue to a large degree on the 3508, the main form. But on the EZ application, they kind of took that out of the process, because on the EZ application, they ask you, how many people did you have at the start of the covered period? They don't ask you how many you had according to, your application and all of that kind of stuff, which is what you had to put on the application for the loan itself. They only want to know, how many people did you have as of the date of the funding of the loan, and then how many people did you have at the end? And as long as that was equal to or greater, they don't care. They don't ask about full-time equivalents or anything else. And frankly, they also allowed you to make your own adjustment to that. So let's say, for example, of the 10 people you had at the beginning of the period, 1 quit, and you offered them their job back and they didn't take it. They just quit. All right. Well, originally that would have hurt you. Under the revised plans, that it doesn't hurt you, and under the new plans, it doesn't hurt you at all. But under the EZ application, if that person was gone through no fault of yours, in other words, you didn't terminate them or reduce their hours, they just quit and went on unemployment or whatever, and you didn't have anything to do about that, you offered them their job back and they refused to take it because they were making more money or whatever their reason was, then at that point, you're off the hook. That you only had 9 people at the beginning, not 10. So if you have 9 people at the end, that's okay too. Even if that person dropped out somewhere in between, they dropped out at the very end of your covered period, um, they don't count because they dropped out voluntarily. So there was finally a provision written in one of the amendments to the law and one of the clarifications by the SBA that said that, if somebody quit, you can't do anything about it. As long as you offer them the job back, you didn't force them out. If they died, if they had whatever, got sick, stayed home, whatever. So anyway, so that was kind of the things that were going on with the PPP. So that's why I say it's good from a planning standpoint to understand what the problems are, and so that you can account for them. So now, switching gears here, what I'm going to talk about now is what you need to plan for relative to the tax law changes that are coming as a result of, or potentially coming as a result of the Biden tax plan. So the Biden tax plan is out. It is out there. You can Google it. You can. It's a long, huge plan. So I suggest you look for a summary. I had a really good summary from the AICPA. They provided a decent summary of it, and so. But there are other things out there. And why am I talking about it? Because and saying, well, why are we talking about this? It's not law yet. Well, remember when I was talking about planning, some of the steps you took, you had to take actually even before, you had the loan. Some of the key was to actually decide what you were going to do before you even applied for the loan, so you knew exactly what you wanted to do. Taking into consideration what potentially could happen. And then if it didn't happen, for example, on the PPP loans, I was applying it so that everybody would spend at least 75%, because the feeling was, and I actually was applying it so it'd be 100, because the original law wasn't clear that if it was between 100% spent on salary and 75% spent on salary, do you lose that? Does that 25% become loan? And then the question was, well, if you don't spend at least 75%, does all of it become loan? And that went through that whole process. And then after the fact, it got reduced to 60%. So we could have done we could have maybe gotten more forgiven, but we did get it forgiven, and you didn't know if it was going to go to 60%. So if you're at the point where you did the right thing and you counted for 100, then you knew you were going to get it forgiven. If you were counting on it being 75 and it wasn't, you could have gotten in trouble. Now it went down to 60, but there was still a question: what happens if it goes below 60? All of that stuff was an issue that could cloud forgiveness, and so it was very important, way ahead of the process, to know how much to ask for. And so that was a key. So it's the same thing with the tax plan. The reason we're talking about it is that by the time it goes into place, it will be too late. And what am I talking about? Well, almost all tax law, the way it works is this: it has to come out of the House of Representatives. So the tax law is generated in the House. And so the House Tax Writing Committee is going to be the first committee to start working on this plan. Now, they've already probably worked on it. They already they're already familiar with it. They're Democrats that control the House, so they already have been in contact. Biden's given them the plan. They probably were involved in structuring some of it. So they're going to be ready to go. And it's probably going to get into committee pretty quickly and start being discussed and proposed, probably as soon as the Secretary of Treasury is appointed and in place, and as soon as, there's a few other things, the Fed and all of that kind of stuff is in place. They'll be pushing really hard, but it'll definitely be within the first 100 days, and it will definitely be pretty quickly here. They're working on an additional stimulus package, which, of course, is going to have to come in first, and then that will justify the tax package, because the tax package is a extremely onerous package from a tax standpoint. It's going to cost people a lot of money. So you're not going to propose that first. You're going to give people money first, and then you can take it away from people after you've given it to them, after the fact, because this will be second. But it's important to know that, because with tax law, almost always, if it's a higher tax rate, if it's a change that's detrimental to the taxpayer, it won't go into effect prior to the first date they started talking about it in committee. It won't go into effect January 1. It won't go into effect that far back, but it will go into effect the first day they started talking about it in committee, even if it technically changed. So let's say the bill gets proposed next week and goes into committee, then and it gets resolved and passed in June or July or August. Well, it's going to affect any transaction that occurred between, now and that and the time that it was passed. All of those transactions will be under the new law, not the old law, because it's when it goes into committee. So you got to be aware of that first. So that's why some of these actions probably need to be taken almost immediately if you're going to be safe. And when you look at some of these changes, the hope is that there's no way it can get passed. But I can tell you that right now, with the makeup, this is a political process, not an economic process. So this isn't about what makes most economic sense. This is about what makes the most political sense. And so therefore, politically, you have the Democrats that control the House, the Senate, and they control the presidency. So they don't have to worry about overriding a veto, that kind of thing. There's all of those things that they don't have to worry about. So they only have to get the certain number of votes that they need to get this thing in place. Filibuster rules have been relaxed and changed, so the Senate can't hold it up as long and negotiate it out. So bottom line, there's a lot of stuff in here that's going to be potentially very, very, very different than we're used to. And because it's very, very different than we're used to, it means that if we do nothing, we will pay a lot of taxes because we didn't think we would have to. And I'll just give you a couple real quick examples. One of the things that the tax bill does is defines wealthy. And so, you hear people say, we're only going to tax the wealthy. We're only going to tax the wealthy. And in fact, we're not going to just tax, we're going to tax the top 1%. That's who's going to pay. The uber rich, these people are sitting at home collecting dividends. They're not contributing to society. So therefore, we're going to tax them. And so that's kind of what the thought was, right? Well, the bill defines who those people are. And here's who they are on paper. They're anybody who makes jointly $400,000 worth of income or more. So if you've got a couple people that are making a couple $100,000 a year, this is going to affect them. You say, well, still that 400,000 is a lot of money. Well, yeah, it is. But do you think that $400,000 is the top 1% of the people in the country? No, it's not the top 1% of the typical taxpayer and all of that. Not at 400. But it gives you an idea. If you're going to raise tax dollars, you got to raise, if those are the super rich that you're going to tax to the max, and then some, you're going to put penalty taxes on them. What are you going to do to the people that make between 100 and 400? Well, you guessed it. Those rates are going up too. For example, capital gains rate, which is currently 20%, unless you're in the 25% bracket or 20% bracket. And then it's 15%. And if you're in the 15% bracket before the gains, it's 0%. So capital gains are anywhere from 0 to a maximum of 20%. They're going to 40%. That's doubling. Now, capital gains, sale of your house, sale of your stocks, all of those kind of things are capital gains. Long-term capital gains subject to what was a 20%, now 40%. Certain exemptions and deductions are going away. The biggest issue that's going to happen is they're redefining an area that a lot of people aren't familiar with, but they actually have experienced in their lifetime potentially. And that is what is referred to as stepped up basis. So without getting real technical, because people hate technical and but here's what we have right now. Right now, if your family, let's say your mom and dad, between them have less than $22 million in assets, you're not paying any estate taxes. Okay, well, that's good. So if I've got a business that's worth $3 million or let's say $4 million, I got a business that's worth $4 million. I don't have to sell that business to pay the estate taxes. It's exempt from estate taxes. Okay. Now, let's say I had a family house, farm, ranch, whatever, and it's worth $4 million. My family's had this for 35, 40 years, right? They paid $200,000 for it back 50 years ago, and now it's worth $4 million, right? So my mom and dad pass away, and now I'm going to inherit that $4 million piece of property. Well, right now I don't have to pay estate taxes because it's $22 million. And so the ranch is only worth $4 million. Now, under the Biden plan, that $22 million is going to go to $3.5 million. So now I do have to pay estate taxes. On $500,000, I have to pay estate taxes of 45%, roughly 50%. So now instead of no estate taxes, I'm going to have to pay about $250,000 in estate taxes, assuming I don't have any state estate taxes. So now I've paid $200,000 in estate taxes. Okay, well, that's bad, but it's $200,000. I got a $4 million piece of property. Okay, so I can deal with that. Wait. What normally happens is at my parents' death, I would get what's called stepped up basis in that ranch. So that ranch only has a basis of $200,000. That was what was paid for it. That's what you've got records for. But it had a fair market value of $4 million at the date of their death. Well, $4 million is now the cost basis. I get to step it up to what the fair market value was. So now I sell the ranch and I get, because I have to get $250,000 tax, I sell the ranch and I get $4 million. I don't pay any tax on it because there's no gain. So what I've done is I've paid some estate taxes, but I haven't paid any income tax. Okay. Under the Biden rule, the basis of that continues, not stepped up. So now if I sell that property, I have to pay tax on $3,800,000. And even if it's capital gains, I'm paying $76,000 in taxes. So stepped up basis is something we've had forever and ever. It's saved us from a lot of problems, even when they messed with the tax laws before. So that's going away in the tax law. We've got to look at that. And I'll talk about some more of this next week because I'm running out of time this week. But I appreciate you joining me, and hopefully you'll plan for the future because it's going to make a big difference going forward. Thanks for joining us here on Treasure Coast Solutions every Wednesday from 9 to 10 o'clock right here on WSTU Digital 1450. We're Martin County's Heritage Station.